It may seem simple to take your money and invest it in various investment vehicles. However, becoming a good investor can be extremely difficult. According to stats, the vast majority of non-professional investors lose money every year. There may be a range of explanations for this, but one that any investor who works outside the investment industry knows is that they don't have the time or resources to study a large number of stocks, and they don't have a research team to assist them. The moral of the story is that if you don't do enough homework, you'll lose money. The bad news is this. The good news is that by focusing on a few main variables while investing, you can reduce your risk as well as the amount of analysis you need to do. To know what exactly you need to learn from buying stocks, please keep on watching till the end of this video. Don't skip any minute because you might miss out on a lot. So let's get going. Investors and potential investors make money in the stock market by determining the best price to pay for a stock or the best price to sell a stock. While it seems to be self-evident, it is not without difficulty. The first step is to find the best deal. But what is the best deal? Different investors will react differently, but they will all agree that you should buy below the future price. Of course, predicting the market's price for a stock in the future is difficult. There are numerous methods for calculating a future price. However, since we can't predict the future with certainty, any future price is merely a best guess. You will have a better chance of determining a current fair value price that differs from what the market is willing to pay. A fair market value, also known as intrinsic value, is an estimate of how much a company is worth as a going concern. It takes into account the company's ability to produce free cash flow, which is cash remaining after all the bills are paid and current debt obligations are satisfied. This is money the company can use to fund expansion, buy other companies, pay dividends, or simply bank for future use. A high level of free cash flow indicates that the business has a competitive advantage over its rivals. The size of a company's advantage or economic moat influences how strong the company's future appears to be. When it comes to equity investments, there are several factors to consider. Here are a few that any investor can look into before making a stock purchase. Earnings. Look for businesses that have increased their profits year over year. An occasional hiccup during recessions is acceptable, although this isn't a perfect measure, and remember that accounting fees will minimize earnings. It's one worth considering. Make sure the target company's earnings are significantly higher than the sector's. You can find these figures in the stock research section of Yahoo Finance. Compare it to major rivals as well. Free cash flow. Strong businesses raise a lot of cash and, more importantly, have a large free cash flow. After the company reinvests in itself to keep the business running, free cash is what's left over. Another way to think of it is how much money you will get out of the company without having to adjust how it operates, which means closing plants, layoffs, and so on. Return on assets. The return on assets informs investors whether or not a corporation is making good use of its assets and generating value for its shareholders. How effective is the business at generating profits? Strong businesses outperform their industry in terms of return on investment. Two firms, for example, each have $100 in assets. The assets are used by one company to generate $5 in earnings, while the assets are used by the other company to generate $15 in earnings. Which would you like to have? For a valid search, compare companies in the same industry. Return on equity. Another way to assess a company's profit-generating potential is to look at how it manages debt in addition to cash. Since most businesses rely on debt to operate their operations, it's crucial to factor it in. Return on equity considers how effectively a business uses its investors' money, including debt. It's crucial to equate businesses in the same industry. If a company's return on equity is significantly higher than its industry, be cautious that something odd is driving up the figure, like recent acquisitions, buying back stock, and so on. Net margins. The net margin of a business is actually net profits divided by revenue. This indicates how successful the company is at extracting money from sales. Some sectors, such as grocery stores, have poor net margins and must produce a large amount of revenue to make a profit. Due to the nature of the market, other manufacturing sectors have higher net margins, like software, for example. Great businesses outperform industry averages and direct rivals. How to pick stocks. Do your homework before buying stocks. If you want to try your hand at stock picking, you must first do your research. The goal is to find a good deal, especially if you plan to keep an asset for a long time. However, before putting your entire trust in a firm, you should conduct a comprehensive analysis evaluating the stock's fundamentals to track its viability and determining whether it still has a place in your portfolio. This isn't just a stock purchase. You're becoming a shareholder in a firm, so investors must be prepared to do their homework before they invest their hard-earned money. Trends in earnings growth. Look for patterns in a growth of a company's earnings. Is it true that earnings rise over time? If this is the case, it is a positive sign that the business is doing something well. Even a minor consistent change over time can be a positive sign. However, in order for the stock to be worth investing in, earnings growth and valuation must go hand in hand. Baron Doggs, founder and CEO of Harrison Wallace Financial Group in Libertyville, Illinois, says evaluating an organization is a combination of knowing how the business operates and how important the potential cash flows are. This entails a thorough examination of the company's products and/or services, target market, and cost structure. Company strength relative to its peers. Begin by examining a sector that is represented in the market and determining if it has future growth potential. When it comes to saving, the industry can be a great screener. When selecting individual stocks in a market, however, you must consider the company's position. How does it compare to the competition? Is there a distinguishing feature that helps it to stand out? These crucial questions will help decide whether or not an organization has a competitive advantage. Evaluate the growth of revenues and earnings and review the statement of cash flows to make sure that those sales are translated into real cash earnings for the business, says Greg McBride, Chief Financial Analyst at Bankrate.com, when comparing a prospective company to its peers. To make a fair comparison, line up competitors of the same size or market capitalization and review their performance during the same time. Debt-to-equity ratio in line with industry norms. Both Amazon.com and Apple are in debt. Debt can be used by investors to gauge a company's financial health. Companies with a high debt-to-equity ratio should be avoided. Divide the total liabilities on the balance sheet by the total sum of shareholder equity to get this figure. That number should be 0.3 or less for those with a lower risk threshold. There are exceptions to this rule. Consider the debt-to-equity ratio in a given sector. With its dependence on debt financing, a higher ratio might be appropriate in the construction industry. Make sure your choice adheres to industry standards. Price-earnings ratio can help provide market value. The P/E ratio is a valuation indicator that determines how well a stock's price performs in comparison to its earnings. P/E ratio is a significant predictor of whether a stock is undervalued or overvalued by using fundamental analysis and value investing strategies. It provides information about a stock's market value or how much it is worth in terms of financial markets. Divide the company's share price by its earning per share to get the P/E ratio. The P/E ratio is 16 if a company stock is trading at $40 per share and its earning per share is $2.50. When comparing companies in the same industry or market, the P/E ratio may be useful. How is a company treating its dividends? A business that pays dividends is likely to be stable, especially if it has steadily increased its payout year after year for decades. However, be wary of companies with extremely high yields. A rise in dividend yield may indicate a company's desperation. High dividends can also indicate that a company isn't investing enough in its own future. During difficult economic times, a company may temporarily or permanently reduce its dividend to secure more liquidity. This does not necessarily mean the company is in jeopardy. Rather, the company may need additional funds to cover immediate costs, and investors should should not be concerned at this time, according to experts. Sometimes a business or sector cuts or removes the dividend because it's in irreversible decline and a sign of things to come, but other times it may be because they're temporarily in trouble, McBride says. Consider the company's and industry's long-term merits to see whether dividends can be reinstated in the future. Effectiveness of executive leadership. How much do you trust a company's top executives? Effective leadership fosters a healthy and long-lasting corporate culture that prioritizes creativity and versatility. Companies that reinvest in themselves expand their company and gain a stronger position in their industry. Stock prices that are trending higher are also indicative of a well-managed business. Strong company-level analysis requires that investors have an understanding of the range of possible futures in both qualitative factors like company culture, employee and customer satisfaction, brand recognition and loyalty, and quantitative factors, says John Kunison, Vice President and Chief Investment Officer at Baker Boyer Bank in Walla Walla, Washington. Investors may make assumptions about a company's prospects and the path that management is going based on this data, which can help you make better stock selection decisions. Long-term strength and stability. The stock market is inherently unpredictable, at least from day to day and year to year. A company's stock value will depreciate at some stage. What matters most, though, is long-term stability. Trend lines, on the whole, smooth out and go higher. Check with individual businesses to see if this is the case. It's probably a smart idea to invest in a business that weathers downturns and emerges reasonably healthy, and that only seems to have real problems when everybody else does. Finally, a stable business has good characteristics of the things on this list. It increases sales, keeps debt low, is competitive in its market, and has successful leadership. There is nothing equivalent for thorough analysis. However, investing for the long term, taking advantage of dividends, and selecting stocks with a track record of success is a crucial way to preserve your investments. Risky and volatile trading strategies should be avoided or reduced unless you have the time. As we come to the end of this video, I want to thank you for watching our video. Please don't forget to subscribe to our channel and activate the notification bell to not miss out on any new content. Give this video a thumbs up if you like it and found it beneficial. Thanks, and see you next time.